For 3 straight years, rents across the United States did what most economists thought was impossible. They rocketed upward at a pace not seen in modern history. From Miami's waterfront towers to Seattle's rainy high-rises, landlords acted like the new royalty of the economy. Overnight increases weren't shocking anymore. They became the norm. People paid whatever it took just to keep a roof over their heads. But 2025 has flipped the script. The power landlords once held is fading fast. Cities that overflowed with renters are suddenly running out of them. Entire metros that couldn't build fast enough during the boom are now swimming in empty apartments. For the first time in a decade, rents aren't just easing, they're dropping sharply. Incentives are everywhere again: discounts, fee waivers, bonus months, even gift cards. Developers built far too aggressively, investors gambled on endless growth, and renters, exhausted by years of climbing prices, finally hit their breaking point. In several markets, rents are tumbling by double digits, shocking even seasoned analysts. Landlords are scrambling, tenants are finally negotiating, and the balance of power in America's housing landscape is shifting in real time. This is Discover the Nation, where we break down the forces reshaping the country from the ground up. Today, we're counting down the top 10 U.S. cities where rent is collapsing and where landlords are officially in panic mode for 2025. Make sure you stay with us all the way to number 1, because the situation unfolding there may redefine the rental market for years ahead. And if you want more cinematic deep dives into America's economic turning points, don't forget to subscribe. The countdown starts now, and number 10 will surprise you with how fast its boom turned into a hard crash. Austin, Texas. Austin's rise to fame wasn't just fast, it was explosive. Between 2020 and 2023, the city became the unofficial capital of America's tech migration. Remote workers arrived in herds, venture capital poured in, and startups fleeing the coast branded Austin as the new Silicon Valley. For a moment, it genuinely felt like it. The skyline transformed almost overnight. Cranes peppered the horizon, luxury rental towers rose block by block, and landlords treated rent increases like a routine. Waiting lists stretched for months, and high-income newcomers kept demand sky-high. But 2025 tells a different story. The momentum broke, and it broke hard. Average rent in Austin has plunged roughly 14% year over year, one of the sharpest drops in the entire Sun Belt. Thousands of sparkling new units that were supposed to house the next wave of tech talent now sit eerily half-empty. Rooftop pools that once hosted weekend crowds now echo with emptiness. Why the sudden freeze? The tech slowdown delivered a punch. Layoffs across giants like Meta, Oracle, and Tesla pulled the rug out from under Austin's high-earning renter base. Buildings that once bragged about waitlists like the Independent or 70 Rainy now wrestle with double-digit vacancy rates. In East Austin, where culture and creatives once fueled a local renaissance, landlords are openly slashing rents, stacking incentives, and begging for leases. Investors who bought shiny luxury units at peak pricing are discovering their returns have collapsed under rising loan costs and disappearing tenants. For renters, the squeeze that once made Austin feel impossible to afford is finally easing. For landlords, the era of easy profit is gone. Miami's rise wasn't just big, it was flashy. Fueled by pandemic migration, crypto millionaires, and global investors hungry for luxury real estate, the city morphed into a symbol of wealth and reinvention. Between 2020 and 2022, rents soared more than 60%, pushing locals out and transforming every glossy high-rise into a status icon. But 2025 has delivered a cold dose of reality. Miami's rental market, once unstoppable, is showing unmistakable cracks. Average rents have dropped around 11% year over year, and vacancies are spread across the city from Brickell's dense financial core to the sandy streets of Miami Beach. Buildings that once boasted oceanfront prestige and over-the-top amenities are now offering free parking spaces, zero deposits, and even four-figure gift cards just to stay competitive. But the biggest threat isn't falling demand, it's rising costs. Insurance premiums in South Florida have tripled in some cases. Condo associations are hiking fees to meet strict safety regulations put in place after structural failures. The result, thousands of investors are bleeding money month after month. Condos that once commanded nearly $1 million are sitting unsold or selling far below peak values. Airbnb hosts who thrived off tourism surges are retreating as occupancy dips and repair costs mount. Even international buyers, once Miami's lifeline, are hesitating, wary of storm risks and endless assessments. From above, Miami still glitters, blue water, sunlit towers, postcard perfection. But beneath that beauty lies a financial structure cracking under its own weight. Atlanta, Georgia. Atlanta was long seen as the South's sure thing. A vibrant job market, affordable homes, and a steady stream of newcomers made it feel recession-proof. Developers believed Atlanta could absorb anything, so they built endlessly luxury apartments, mixed-use complexes, suburban expansions. But by 2025, that confidence has cracked wide open. Rents have slid nearly 9% year over year, and vacancy rates are climbing at a pace the city hasn't seen in a decade. High-rises from Midtown to Buckhead that used to fill overnight now sit dotted with empty floors. Developers are scrambling to keep tenants. 3 months of free rent isn't unusual anymore. Free parking, waived deposits, discounted upgrades, it's all back on the bargaining table. But Atlanta's strain goes deeper than too much construction. Wage growth has stalled, inflation has eaten through household budgets. Student loan repayments kicked in again, forcing many younger renters to downsize, double up, or move back home. Even the suburbs, once Atlanta's pressure valve, are cooling. Cobb, Gwinnett, and Henry County all report stagnant single-family rentals and investors slashing prices to stop monthly losses. The root problem: the city built for luxury, not livability. Developers assumed renters would always stretch their budgets. But when that assumption snapped, the market buckled. Atlanta's growth story never collapsed in a single moment. It slowly suffocated under rising costs and unrealistic expectations. Now it must confront a reality many didn't see coming. Even the strongest Sun Belt markets can stumble. Las Vegas, Nevada. Las Vegas has always lived by one rule: high risk, high reward. For years, the city thrived as Californians poured in, chasing lower prices and sunny optimism. Investors scooped up homes, short-term rentals exploded, and developers assumed the growth streak would never slow. But in 2025, the tables have turned. Rents have fallen nearly 10% since 2023, and vacancies have doubled across many neighborhoods. Apartment communities in Henderson and Summerlin, once overflowing with demand, are suddenly half empty. Tourism, the city's beating heart, still hasn't rebounded to its pre-pandemic strength. Casino hiring is sluggish, convention traffic is lighter. Service workers, who formed the backbone of Vegas' rental demand, are earning less than they used to. Meanwhile, thousands of Airbnbs built for weekend vacationers are flooding the long-term market. Yet construction keeps moving. Projects launched during the boom are reaching completion, adding wave after wave of new luxury units just as demand shrinks. The city feels eerily reminiscent of 2008, not because of the same causes, but because of the same pattern: speculative confidence outrunning real-world sustainability. Vegas's bright lights still glow, the Strip looks alive. But off the boulevard, empty units, price cuts, and investor exits tell a story of a market that misjudged its limits. Phoenix, Arizona. Phoenix spent the past few years as the poster child of Sun Belt migration. Families arrived from California, Washington, and the Midwest in waves, pushing demand to historic highs. Developers responded with fierce enthusiasm, constructing new apartments, townhomes, and master-planned communities at a breakneck pace. But 2025 has exposed the limits of that optimism. More than 30,000 new units hit the metro area within a single year, overwhelming demand. Average rents have dropped to roughly 12%, and landlords are stacking incentives just to get people through the door. Free months, fully furnished units, prepaid utilities. These once rare offers are now standard across much of the valley. But oversupply is only half the story. Phoenix's job market has cooled significantly. High interest rates slowed corporate expansion, and the migration surge that once defined the region has leveled off. The result, too many units, not enough renters. Investors who bought brand new homes during the pandemic with expectations of endless appreciation now find themselves underwater. Insurance costs are climbing, maintenance costs are rising, and property values have softened. From Chandler to Mesa, and all the way up to North Phoenix, landlords are fighting to fill units that seemed guaranteed just 2 years ago. The skyline still shines with new construction, but many of those projects feel more like reminders of a market that grew too fast for its own good. Phoenix promised endless expansion, but in 2025, the desert heat has cooled into a sobering correction. Texas Dallas has long been one of America's economic giants, a city fueled by corporate relocations, rapid job growth, and sprawling development. For years, it felt almost untouchable. Uptown, Frisco, Plano, everywhere you looked, demand seemed endless. But 2025 has exposed a surprising truth. Even Dallas has its limits. Rents across major neighborhoods have fallen around 10%, and class of vacancies are higher than anything seen in the last decade. Developers built aggressively from 2021 through 2024, convinced the pipeline of new renters would never slow. But inflation cut into disposable income, interest rates rose and stayed high. Younger renters began moving in with roommates or returning home. Suddenly, the demand developers relied on evaporated. To stay afloat, landlords are offering free utilities, covered parking, reduced deposits, and monthly rent credits. Investors who expected easy cash flow are now navigating rising property taxes and higher insurance costs, an increasingly painful combination. Dallas's corporate strength isn't rescuing the market this time. Hiring has paused in key sectors like tech, finance, and real estate. Meanwhile, locals who once shaped the character of neighborhoods like Deep Ellum and Oak Lawn have been priced out, leaving pockets of vacancy behind. The skyline still gleams across the Texas night, but beneath it, landlords are recalculating their strategies. Dallas, a city built on momentum, is learning that even momentum can stall. Boise, Idaho. Boise became the pandemic's breakout star. Remote workers seeking affordability, nature, and simplicity flooded into the city from high-cost metros like San Francisco, Seattle, and Portland. Housing demand erupted almost instantly. Homes sold in hours, rents doubled, and developers sprinted to build anything they could, but the wave didn't last forever. By 2025, Boise is experiencing one of the steepest corrections in the Mountain West. Average rents have dropped around 13%, and vacancy rates have climbed at a pace few predicted. Buildings that once filled within days now sit stubbornly empty. High-end complexes built for well-paid remote workers are struggling to attract the city's local workforce. Teachers, nurses, hospitality employees who never earned Silicon Valley incomes to begin with. Meanwhile, the remote work boom that fueled Boise's rise has softened. Many of the transplants who arrived with big budgets and bigger expectations have moved on, leaving the city overbuilt and oversupplied. Even suburbs like Meridian, Nampa, and Eagle are feeling the slowdown. Construction projects have stalled mid-build. Investors are offloading properties with shrinking returns. Restaurants, boutiques, and local shops that thrived during the influx are now cutting hours or closing altogether. Landlords are advertising discounts of $300, $400, sometimes $500 per month, and still struggling to fill units. A skyline that once symbolized booming opportunity now feels frozen in transition. Boise's story is a reminder that no city, no matter how charming or fast-growing, is immune to the realities of economic gravity. Seattle, Washington. Seattle's skyline has always represented innovation, cloud computing, global corporations, and a generation of high-earning renters powering endless demand. For more than a decade, rents climbed almost continuously. Cranes dominated the horizon, and developers treated expansion as a guarantee. But 2025 paints a different picture. Rents have fallen roughly 10%, and vacancies are spreading through neighborhoods once considered untouchable. Capitol Hill, South Lake Union, and Belltown areas long anchored by the tech economy now feature rent specials and incentives that would have been unthinkable 5 years ago. The tech slowdown hit hard. Layoffs across Amazon, Microsoft, and dozens of smaller startups hollowed out Seattle's strongest renter base. Downtown towers that once carried waiting lists are offering cash bonuses and free months to keep occupancy stable. Even the suburbs Bellevue, Redmond, Kirkland are seeing lease renewals drop sharply. Developers who planned projects around the assumption of endless demand are now staring at empty units and construction delays. The shift isn't only financial, it's cultural. Remote work changed lifestyles permanently. Many former Seattle residents have chosen quieter, cheaper markets with more space. The outward migration isn't a tidal wave, but it's steady enough to reshape demand. Seattle's glittering towers still reflect the morning fog, but inside many of them, hallways are quieter, lobbies are emptier, and lease offices are feeling the pressure of an oversaturated market. San Francisco, if any city embodies the word collapse, it's San Francisco. Once the epicenter of American innovation, the 2025 rental market has left the city almost unrecognizable. Rents are down roughly 15%, and downtown vacancies have shattered historical records. Towers that once charged $4,000 for a one-bedroom now struggle to fill units at $3,000 even with incentives. Remote work transformed the city permanently. The tech exodus never reversed. Downtown streets, once buzzing with startups and dreamers, now echo with emptiness. Investors who bought at peak valuations are stuck unable to refinance without taking painful losses, but the most damaging shift is perception. Concerns about safety, cost, and livability have pushed renters toward cheaper alternatives like Sacramento and Austin. Even the city's cultural heartbeat, its restaurants, galleries, and independent shops is fading. Yet even San Francisco's decline isn't as symbolic as what is unfolding in New York City, our #1 metro of 2025. New York's rental market, long considered indestructible, is finally showing strain. Manhattan rents are down around 12%, with Brooklyn and Queens dropping even more. Incentives, free months, waived fees long gone for years are suddenly standard again. Developers overbuilt. Corporate layoffs drained the city's professional class. International buyers pulled back. Even ultra-luxury units on Billionaires Row are being repriced downward. For the first time in living memory, renters have negotiation power in New York, and landlords big and small are feeling the pressure. Across the country, the same message echoes. After years of runaway growth, America's rental market is resetting. Some cities will rebound, others may not, but the era of unchecked price hikes is over for now. And this shift is only the beginning because the next housing cycle is already forming beneath the surface. Let us know which city we should investigate next.